Welcome back. So, now we are going to start a new session, and in this particular session we will be focusing on the micro foundations of international trade. So, all of you, those who are familiar with economic concepts, you must be knowing that one dimension that we always talk about, we economists always fascinated to talk about, is the international trade. And what do we do in this particular area? So, we try to understand the behavior of, or I would say movement of goods and services. So, how the countries are reacting with their exports and imports. So, if you have more of import, then it becomes a burden for the country that you will have to pay more of your wealth to compensate the or to meet the import demand. If you have more of exports, then it becomes really interesting for the a country, because then the country will be earning more of foreign assets. So, in most of the international trade analysis, we often find that the understanding of international trade becomes really important. And if you read the basic textbook, Dominic Salvatore or even the Higgins, you find that there they talk about more of gains from trade, and they mention also about that how the smaller economies. So, the basic theories that we have in international trade, which is about the absolute advantage and the relative advantage theories. So, there we talk about in absolute and relative sense, that whether the country specialized in a particular product has the relative or absolute advantage, then what will be the facilitation of trade. So, whether these countries should be trading or not. Without trade scenarios, which we normally name the autarkic scenarios, are those scenarios in which the country does not have any exposure to the international trade, which means no goods and services flow from one country to another. And if the country is operating in that in that setup, then we just consider the domestic economy functions. So, international trade has a lot of meanings, and especially at the time when you have a speed of communication really high across borders, and we find that it is not just the manufacturing, it is also the services sector which is playing a role. You have a lot of foreign trade agreements. Then we started with 1944 when we had set up the general agreements on tariffs and trade, GATT. Then we moved to World Trade Organization. Then we have different regional trading blocks. Then you have monetary union. So, all these have lot of implications on the international movements of goods and services. So, factor movements play very important role. In this particular session, we will be focusing on certain dynamics which are related with the micro foundation. So, we will have the mix of, so we have already done the 2-period model. So, we will be trying in the 2-period context the very basic framework, and that too in a very small open economy model. Why small is open economy model? Because it helps to draw the map or the contours at the broader level. So, maybe if I am talking about the small economy, so maybe the Luxembourg, maybe Maldives. So, if you want to understand, if you are able to understand the dynamics of trade in these smaller economies, then maybe at the larger level you can have some overview, and may be your theories may give you the different insights. So, most of the micro foundation theories, they target at the smaller problems, smaller agents, and then they try to generalize at the macro level. So, in the very first class that we had discussed about the macro foundations, and this is also the topic of this course, that we are trying to understand each and every macro phenomenon from the micro perspective. So, we are introducing governments, we are introducing consumers, we are introducing firms, and then we are seeing with respect to productivity, with respect to government expenditure, with respect to consumption. So, these dimensions are really important. We will be also trying to see what we have already done. So, this particular session is going to be more familiar if you have already gone through the rest of the slides and lectures that I have shared. For example, I will be using the 2-period consumption lifetime budget constraint. So, that we have already covered. We will be using the Ricardian equivalence concept, which means that the tax smoothing framework. Under that, if the government is going to introduce tax, then how the individuals are going to react. So, we will be introducing that also. So, that we call it as Ricardian equivalence framework. Then we will be also trying to see that if you have different interest rate scenarios. So, if interest rate is going to go up and you are borrower or lender, how you will be reacting to that. So, whether with respect to the open economy, whether it will be the same or it will be different, right. So, when I talk in the context of consumer, then we talk about the borrowing and lending of individual consumer, but when we talk about at the international trade level, then we say that it is about the country. So, if the individual in the 2-period model was making decisions about saving, here saving implies that it is saved at the country level. So, country is saving. Borrowing and lending that I talked about, borrowing and lending in case of individual consumer, it will be with borrowing and lending happening with one institution or another. Here this particular country will be participating in the international credit market, where it can go for lending or it can borrow from that market. So, that kind of understanding is I would say crucial before we start formally the model. So, I hope it is clear that international trade, when we mention about international trade, has facilitated the dimensions of many economies. Majority of the economies which are dependent upon exports are doing well. So, for example, South Korea, it is export driven economy. Japan is also more or less export driven economy. If we are talking about China, is export driven economy, it is led by manufacturing sector. So, most of the countries, they focus on the international trade, because with the international trade you have two things, that you have a movement of goods and services. Second thing is the movement of culture, movement of know-how about new technology, new processes. So, this knowledge transfer which is happening through import and export of goods and services, it is of immense importance, because then you have different universities, different colleges using those tools and technique, and then it further improves the efficiency of their production, and then it also broadens the understanding about a particular process. Then maybe after some time the country will be going for import substitution policy. In the modern era, we are in 2022. So, in modern era, if you try and understand the role of international trade, then it becomes important in the context that how the countries are interacting. When we talk about international trade, so international trade has direct link with the globalization. So, if more and more borders are open, more and more countries are opening their borders, and if they are allowing goods and services, even factor movements, which means that labor is free to move from one place to another. If it is happening in that way, then we say that it is some kind of open economy framework. Then you have the dimensions of goods and services, export, import, people will be interacting at different level, movement of capital from one region to another. So, with the availability of high speed internet, it has facilitated a lot. So, nowadays you must be seeing that the emerging economies are becoming the global hub of services sector, and India is one of the leading countries in that regard. So, international trade, though in the beginning it was part of the macroeconomics, but over a period of time, with the evolution of the international trade as a diversified sector in most of the economies, you have different complexities in the international trade. So, nowadays international trade has become a different subject, and it has become a separate discipline from macroeconomics, and it has more to deal with the dimensions which are more related with the cross border transactions and cross border movement of goods and services. So, if you ask anyone who is doing master or bachelor degree in economics, you will if you ask them that which all courses you have done, then they will be mentioning macro and international trade separately, because in the beginning at the very basic level the international trade becomes part of the open economy macroeconomics, but if you want to specialize yourself at the goods level, at the different activities level, then international trade becomes a separate discipline. So, this introduction I am giving, most of I am sure most of you are aware about this, but those who are from non-economics background, I think it is crucial that you should have such type of background in your mind, and then we will be thinking about. In macroeconomics, normally when we talk about open economy macroeconomics, in nowadays we deal more with the exchange rate, that how is the exchange rate, how is the US dollar is being exchanged with rupee, and if we are going to talk about exchange, then if what will be the impact of exchange rate on macroeconomy. So, when you have the exchange rate appreciation, then what will happen, which means that if the dollar is getting weaker, your rupee is getting stronger. So, earlier the dollar was being purchased at 76 rupees. Now, you are buying at suppose 48 rupees, then that is called the appreciation. What is the impact of that, how it transmits to different goods, what is the pass through to the inflation, what is the pass through to the real economic activity. All these things are these days part of macroeconomics in, I would say, in detailed context. But if you try and understand from the perspective of what we call it the international trade as a subject, then international trade as a subject, you will have the dimensions of tariffs, quotas, you have monetary unions, then you have a lot of free trade agreement, different theories regarding the gains of trade, there are different theorems talking about at product level with different classification level. So, international trade becomes really interesting if you want to analyze at the balance of payment level, different compositions, movement of goods and services, whether you have one advantage over another. So, these dimensions are really important. So, in today's session we will be talking about those kind of dimensions. So, for this particular lecture, the reference remains same. So, I have referred the Stephen D. Williamson book. So, it is about the macroeconomics, and it is the 6th edition is widely popular, and this particular book I have already referred for many sections. So, I think you are already familiar with this. So, the objective of this particular session is that we will be trying to set a micro foundation model, microeconomics based model for the small open economy, and then from there we will drive the international trade idea. So, basically we will be talking about balance of trade. So, balance of trade means that you have the we will be talking more about the current account I would say surplus deficits in which all contexts. We will be touching upon a very important topic, which is about the current account balance that I mentioned. We will be talking about the very important topic that needs attention, is about how the credit market imperfection leads to default or indebtedness in countries. So, once I talk about indebtedness, then it talks about the what is the likelihood of default of a country on the debt. You will be surprised that in most of the cases what we find that it is not just the size of the debt, it is also the debt servicing, which means that the rate of interest offered on the bond, that also becomes the major challenge. So, during 2007-8 global financial crisis, Greece defaulted on its sovereign debt, and later it became full-fledged sovereign debt crisis. One of the reasons was that Greece defaulted on its debt because of the rate being offered. So, rate was much higher than most of the countries, but later part when it became part of the European Monetary Union, then even after that it continued. And once you have, suppose you have a Germany offering the bond rate of around 4% on its sovereign debt bond, you have a Greece which is offering you 14% and 15%. Of course, the burden of servicing the debt will be a big challenge for the Greece, because the bond being offered 14% means that you have to generate that much amount of money. For that reason, you should have the tax collection rate higher, you should have less leakage, you should have more of the investment and consumption activities taking place, so that you have more multiplier effect in the economy, right. If those things are not functioning, then it becomes really a big challenge. In case of Japan, Japan is also a country which has the one of the highest or the debt to GDP ratio 200, more than 200%, but Japan does not become the case of Greece, because it has the less likelihood that it will be defaulting on its loan because of the macroeconomic scenarios and also the tax efficiency. So, if the government is going to charge a tax, it collects efficiently, and then whatever rate of interest being offered on the bond, it is also much lower. So, from the bond market perspective, it becomes really important that how the countries behave in the international bond market, and if the countries are going on repetitive borrowing and they are not servicing the debt, and if they default, then it will be very high likelihood that these countries may not be getting the debt from some other country. So, that aspect becomes a big challenge, that how are we going to deal with. Here we also try to understand that here we focus on what are the, so as I mentioned about the debt default. Towards the end, we will be also putting up some scenarios that what happens if we have the production investment, if I superimpose the condition of interest rate on different activities, then how does it look like. So, all those dimensions are important and it is worth investigating, and that is what we thought that we should be mentioning. So, let us start. So, we assume that we have a small open economy model. So, let us take the example of Luxembourg or any small economy, island economy you can take, or any smaller countries that you have in mind. So, in this particular country, you have a one representative consumer who lives for only 2 periods. He is having only 2 periods, which means that current period and the future period. In current period, he has some income, and he also receives some income in the future period. In both periods, whatever income he is receiving, it is exogenous, which means that it is not coming, it is just, you can think about it as coming from somewhere. So, we are just assuming that this particular the income system is independent of whatever happening in the economy. So, here we are not bothered about how much it is going to form and how much form is coming here. We are just assuming that this particular individual is having some amount of income, right. Representative consumer current period and future period incomes. The small economy model is a price taker in the world credit market. It means that it can go for borrow and it can borrow and lend in the international market. So, here we assume that the interest rate is not decided within the economy, interest rate is decided in the international market. So, international market, most of the countries which are participating in the world credit market, they decide about. So, mutual agreement on a particular rate, it becomes the rate for everyone. So, for example, the Eurozone countries, so a small economy in the Eurozone countries, so whatever is decided by the European Central Bank, it becomes for everyone. So, here we think about that way. Current account surplus is equal to savings in the small open economy, and there is no investment. So, whatever surplus that you have, it goes in the form of saving, which means that it will earn some amount of rate of interest in future. So, if you have current account surplus in period 1, whatever is the amount, 1000 rupees, 2000 rupees or 5000 rupees, if you are carrying forward to the future period, it will earn 1 plus R. So, it will be CA in the current period, but in future period it will be CA into 1 plus R. So, some kind of rate of interest is going to be attached. So, this is how we deal with. Now, we have the representative consumer, and this representative consumer, I think we have already done this part. So, let us not spend time here. So, here it is simple that this is the lifetime budget constraint of the representative consumer who is living for 2 periods, period 1 and period 2. Period 1 is denoted by C and period 2 is denoted by C transpose or C dash, right. Here you have the present value of the future consumption. So, this is the expenditure, this is the consumption, and this is the income. The representative consumer is also supposed to pay tax. So, and this tax, for the sake of simplicity, we are assuming that this tax is of lump sum type. It is not a proportional type. It is not being introduced on the interest rate. So, it is not 1 minus tau, it is just the t. So, here you have y minus t plus y transpose minus t transpose. So, this is what we have the consumer lifetime budget constraint. Similarly, if the individual is paying the tax t, this is going to the government. So, government here we have the government's intertemporal budget constraint. So, in this case here you have the government in the current period. So, this is the expenditure and this is the income. So, tax revenue, so lifetime tax revenue is equal to lifetime government expenditure. So, this is what, so the amount that the government is receiving from the representative agent is, it is using that for expenditure. So, if you have a G increasing, it means that T is also going to increase for this particular representative consumer. So, it becomes really important to understand. So, I hope these two dimensions are quite clear to all of you, that we have already covered this part. So, there should not be any doubt on this particular aspect. Now, finally, once I have derived the government budget constraint and I know that the government saving is nothing but how much it is collecting the tax and how much it is using that tax as an expenditure, right. If government is not saving at all, right, so it means that even if you have Ricardian equivalence, it will not fail, and there will be smoothing of tax transfer, right. So, in this economy SG is equal to T minus G, where there is no investment. The current account surplus in the current period is this. So, when we introduce the international trade dimension, so far we have discussed only the consumer, we have discussed the government, we are discussing now the open economy context. In open economy, you know that in the balance of payment you have two types of indicator, one is the current account, another is the capital account. In current account we talk about the difference between export and import. So, that is why in national income accounting we often use Y is equal to C plus I plus G plus NX. NX means net exports. So, that becomes part of the current account, and capital account which talks about the movement of financial capital. So, that may have some restrictions. In India we have not allowed, in case of foreign countries you have the capital account convertibility, but in case of India we have not done that. Current account. So, here we have the current account is equal to saving minus investment, right. So, this is what we have, which is equal to saving is nothing but private saving plus government saving, and since investment we are assuming. So, once we have the current account surplus, it includes the saving component, it does not include the investment. So, here we have SP plus SG minus investment is 0. What do we write as an equation is that here it becomes Y minus consumption minus government expenditure. So, at the national level, if you want to see that how is your current account surplus look like. So, here it is almost like Y minus C minus G. So, this is how it looks like. Now, we also derive. So far what we have done is that this is applicable for individual agent, right, and this is applicable for the government. We introduce the consumer, we introduce the government, right. So, this is the consumer, this is the government, this is the budget constraint. We introduce the current account surplus. So, this is what we have. Here we are introducing the national present value budget constraint. So, what is that national present value budget constraint? Here it includes by combining both. If I am going to write here C, so here it becomes C plus C transpose upon 1 plus R is equal to Y minus T plus Y transpose minus T transpose upon 1 plus R. Now, here what I mentioned that since G is equal to T, so I am replacing that T by G. So, it becomes C plus C transpose upon 1 plus R is equal to Y minus G plus Y transpose minus T transpose upon 1 plus R. So, here instead of T I will be using G, it becomes G transpose. So, Y minus G plus Y transpose minus G transpose upon 1 plus R. Since it is becoming part of the expenditure, so if we bring G this side, so this becomes C plus G plus C transpose plus G transpose. So, this will come this side upon 1 plus R is equal to Y plus Y transpose upon 1 plus R. So, this will be the budget constraint that we derive. So, this is what we derive here. What I mentioned here was the same, that I replace T by G. So, if I am replacing T by G, because G is equal to T, whatever government expenditure that government is making, it comes from tax revenue. So, if tax is 100, government expenditure is also going to be 100. So, if it, that's what it implies. So, here we have C plus C transpose upon 1 plus R is equal to y minus t plus y transpose minus t transpose upon 1 plus R. Now, the government intertemporal budget constraint is this, so which is nothing but G plus G transpose upon 1 plus R is equal to T plus T transpose upon 1 plus R. So, finally, what we are getting is the national present value budget constraint, which looks like it is the C plus G plus C transpose plus G transpose upon 1 plus R is equal to Y plus Y transpose upon 1 plus R. What is the meaning? Meaning is that the national present value of the consumption, which is here, plus government spending must equal the present value of national income, then only you have the current account surplus scenario arising. So, for the balance of trade, you should have, this is the component of expenditure that we are accounting. So, consumption of the representative households plus you can say private consumption plus government consumption, that is what we always mention about the expenditure, is equal to the national income that the government that the country is having. And this national income will include everything, net factor income from abroad, everything. So, this is not just about the GDP, it is also about the GNP scenario that we mentioned. So, here we mention about the nation's budget constraint for the current and future periods. So, if you want to just write about how does it look like. So, as I had mentioned that CA includes savings, it does not include investment. So, here we have C plus G plus CA is equal to Y, and here we have C transpose plus G transpose equal to 1 plus R, CA plus Y transpose Y here in the future period. So, this is the current period and this is the future period. In the future period, here you have a C transpose plus G transpose equal to 1 plus R, CA plus Y transpose. Y CA you have 1 plus R, because this is nothing but a saving, and saving will attract the rate of interest. So, here when I mention about 1 plus R, so this is the future value of this CA that the government is having. So, ultimately it becomes in future period, this becomes your expenditure and this becomes your income. So, if the countries are having more of savings, more of current account surplus, it means that it is added to their income, and that is what in the beginning I mentioned about the international trade becomes important, because countries get extra money and that money is added to their national income and then they can invest in certain activities. So, your C plus G will depend upon how much you have the current account surplus plus the output, means which is the Y. So, domestic output plus the external income that you have, that consists that can be used to finance your C transpose plus G transpose. We are going to deal in the further sections, we are going to deal about the consumers making choices over consumption bundles. So, unlike current and future consumption, here we will be talking about the C plus G and C transpose plus G transpose. So, I will be taking forward from here and I will be stopping now, and we have already, I think this particular session has helped you understand the and it has given you the basic premise of what we are going to deal, and I hope that this particular session has been useful to all of you. Thank you so much for your attention.